good morning, everyone. Thank you for dialing into this Policy Insights webinar on pensions tax reform, what's happening and what the PLSA is doing about it. My name is James Walsh. I'm Head of Member Engagement at the PLSA, so it's a great pleasure to welcome you all. So the purpose of this series of webinars is to give our members, PLSA members, some insight into the policy work that my colleagues do behind the scenes when they're trying to influence the government, the regulators, trying to help them develop policies that really work in practice. And this issue we're looking at today, pensions taxation, I think it's a classic example really of where my colleagues have been very busy. They've been briefing officials, talking to MPs, generally ensuring that the policy-making machine understands the issues. If we just move on to the agenda slide, we'll have a look at what we're going to be doing in the next hour. I'm going to be having a short conversation with Nigel Peaple, our Director of Policy and Advocacy, about that lobbying work we've been doing and the approach PLSA takes to tax issues. My colleague Kate Boulden, who's our Senior Policy Advisor on DC, is going to talk us through our report on the principles of pensions taxation. She's got some slides to present, and then we can have Q&A with her. And then we'll hear from Jackie Wells, formerly of this parish, formerly one of my bosses, but now an independent consultant. And Jackie is going to talk about our other report we've done, which delves into some modelling work the Pensions Policy Institute did, on which we've built some analysis of the implications of various pensions tax reforms for some different types of individuals. And then we'll have an open Q&A with all our panelists and all of you. Don't hesitate to type your questions into the Q&A box. You can do that right from the start. I'll be looking out for them and trying to put as many as possible to our speakers. And because I know someone will ask, we will circulate the slides promptly afterwards, and we'll also send the recording of this round. So I'm going to bring in my colleague Nigel Peaple now. Nigel, very nice to have you with us. Good morning to you.
Hi, James.
So Nigel, let's plunge straight in. We know there's going to be a budget on the 27th of October. What are you picking up? What signals are you picking up about the possibility of some kind of reform to pensions taxation?
Well, as you know, James, the government is always enormously tight-lipped about budgets, no doubt for good reasons. We all still remember the stories about the pension freedoms, where the Minister for Pension was told more or less of the morning of the budget, so the story goes. But what we do know, like all of the members dialing in know, is that the government is very short of money. So there's pretty good justification for trying to do something from their perspective. On the other hand, reforms would be controversial and probably painful for some. We've been talking to Treasury and Treasury officials over the last 18 months. It's clear the officials are totally on top of the options and the implications of different types of reform. So I think where I am is that it's, on balance, the likelihood of a reform, it's still 50-50.
Okay, hedging your bets nicely, Nigel. What approach are we taking at the PLSA? I mean, when we're talking to ministers and officials, what line are we taking with them?
So the PLSA position on this has been worked up over some time and after extensive discussion, particularly with our policy board, but also with other bits of our policy governance and also through surveys of our members, so getting their views on it. And basically, our starting point is that pension saving in the UK is inadequate. And so we don't really welcome the thought of a reduction in fiscal support. And clearly, that's where the government will be coming from if it makes any changes, reducing fiscal support. So we thought about reform, and we've identified 5 principles for reform, if reform has to be undertaken, which is basically that it should promote adequacy, that it should encourage the right behaviours, it should be fair, simple to adopt and administer, and enduring and sustainable. So there are 5 principles.
Yep.
We've done, as you've mentioned, 2 reports, one analysing some of the most often discussed reforms, and the other looking at the impact on savers. And our aim is trying to be to make sure the government in particular, but also the media and other stakeholders, really have a good understanding of the implications of what they might do. Because very often, as you see, people get excited. They go, oh, I'd make this change. It'll be extra money for the Treasury. It won't harm anybody. It's all fine. And then all the horrors come out over the following weeks and months. So what we've tried to do is make sure they all know up front what they're doing, and therefore they really have to own the consequences of those changes.
Okay, and when you say having those conversations, Nigel, I mean, who are you having them with? You know, is it ministers, MPs, is it officials, and are they receptive?
Okay, well, I mean, in terms of Whitehall, so we have been setting out our case to the Treasury, to DWP, and so some people in Downing Street. Most of the engagement has been with HMT officials. We've had letter exchanges with the ministers, very polite and helpful exchanges, but letter exchanges. And with the officials, we've really talked in considerable depth about our reports, and we've invited them to the round tables that we put on to talk about them, and they took part and they listened and they've understood. From a more sort of political angle, we've also been sharing our thinking and reports with the Treasury Select Committee MPs, Work and Pension Select Committee MPs, and some wider MPs as well as talking to particular people such as the Labour shadow team. We found people to be very receptive and actually even appreciative of the analytical work that we've undertaken. They do indeed say it helps them understand the issues. One Conservative MP, who's a bit of a specialist in this area and on the Work and Pension Select Committee, he commented that, very useful because, as usual, the high level messaging is right, you pull this lever, you get more money. But then this brings out all the nasties that follow on, often that the politicians don't want themselves to do. But in terms of has anyone given anything away, James, I have to say no. They've been very, very careful. Especially the officials have been very tight-lipped and careful. And I end up sort of trying to interpret what might happen based on the sorts of questions they ask and when I can see the things they've analysed.
Yeah, well, I guess that's how it always is with budgets. You say tight-lipped, of course, that's the protocol. But it's very good that you're getting across to them the detail and the consequences of various reforms. What about the politics, Nigel? I mean, these things do come down very much to politics. We know there's been a lot of disquiet on the Tory backbenches about the recent increases in national insurance and other taxes to fund social care and the NHS. A lot of the Tory MPs not at all comfortable with that. Does that have some sort of bearing, do you think, on what the Chancellor might feel he can get away with on pensions tax?
I think it has lots and lots of bearing on it. And like you say, this year there's been huge tax rises, corporation tax rises, the NI increases, saving money on pensions through the adjustment to the triple lock.
Yeah.
And I'm sure they're calculating, can we do more? On the other hand, some of the reforms, and I think in particular this idea that's being touted about removing higher rate relief, it's one I think politicians would find relatively easy to sell because it looks like there's a small number of losers and many others won't be affected. We've actually calculated that the losers are quite a substantial crowd, maybe about 3 million. Could be losing £2,000 a year, and many of them would be senior public sector workers with a good DB scheme, such as senior doctors in the NHS. So government's aware of that. I have to see how they respond.
Yeah. Okay. What about the Labour Party? I think your team's been talking to them as well, Nigel. What are they saying?
Yeah. Well, when we last spoke to them on this, was a little bit before the summer. They were very much focused on being quite open-minded about removal of high-rate tax relief, and they were also focusing on issues around exemption of some pensions from inheritance tax. So sort of quite classic Labour perspectives on it, really. It didn't look like they'd had a lot of engagement with their public sector trade union members at the time of our talk. Yeah,
interesting. Okay, and finally, Nigel, I know Kate and Jackie are going to run through some of the options, the different reform options. And the implications of those in a moment. But do you personally have any feel for, if the government were to do something, which option they might go to out of, cutting high rate relief or chipping away at the allowances again?
Well, I think you've hit the nail on the head. I mean, we identified about a dozen potential options with our member steering group over the last year. And you're going to hear from Kate in a minute, analysing seven or eight of them. But I think the two easiest things for them to do are either the gradual salami slicing down or freezing of allowances, which they sort of seem to manage quite frequently. Politically, they manage it. But the other thing I think is if they're going to be bold, they'd probably try and remove higher rate relief. But that does have, I mean, basically has a lot of negative consequences, in particular the DB schemes.
Yeah.
So there are many tricky things for them to work through.
Yeah. Okay. Thanks, Nigel. Thanks. Well, Nigel, I'm going to bring in Kate at this moment. We'll come back to you in the Q&A later. Thank you very, very much. So we can get Kate Boulden on the screen, our Senior Policy Advisor on DC. Kate, you're going to talk to us about the PLSA's report on principles of pension taxation, I think, Kate. So over to you.
Yes, thank you, James. So today I'll be talking through our report, the 5 Principles of Pension Taxation, which was published in July this year. The aim of the report was to consider in more detail the impact of often discussed reforms on savers, schemes, employers and the government. I'm very sorry if you can hear my dog in the background, by the way. Hopefully it'll be quiet in a second. So we worked with a senior level steering group of 7 PLSA members, which was set up to consider pensions tax relief issues. If you have any questions as we go along, please do put them in the chat. We'll discuss at the end where we have a special Q&A. So in this session, I'll quickly run through the current elements of pensions tax relief and the fiscal support. I'll then look at the principles of pension taxation, which have been developed by the PLSA. I'll then look at our assessment of a number of reforms against the principles, and then I'll end with some concluding comments. But the key takeaway of the report, and something that Nigel touched on in his remarks before, is that we believe the current system should be maintained, as none of the other reform options would improve what we have now enough to be worth implementing, and some would actively be damaging. So if that all makes sense, let's start with the first topic. So what fiscal support is there for pensions in the UK? As I'm sure you'll all know, the key elements are income tax relief on the employer and employee contributions, no or limited taxation of investment income. The employer pension contribution is not subject to national insurance, and there's also a 25% tax-free lump sum on withdrawal. The system is EET, which means there is no taxation on contributions or investment income, but it is taxed when withdrawn, apart from the tax-free lump sum. There are some constraints on the amount of tax relief an individual can receive through the annual allowance, the lifetime allowance, and also the money purchase annual allowance. So the different reform options I'll be talking through today essentially change one or several of these elements. But before thinking about the reform options in more detail, it's important to consider on what basis changes should be made. So, there we go. So these principles were developed through careful discussion with the PLSA Policy Board and with the senior level steering group. They were also tested amongst our wider membership through a member survey. We believe that any reform that is undertaken should be on the basis of these principles, the most important one being promoting adequacy. As Nigel mentioned, a lot of people already have inadequate savings, so we wouldn't support anything that would cut these savings. So any changes should aim to maintain or increase what we have and not take anything away. So after developing the principles, we assessed several different reform options that have been widely discussed by the media, the pension sector, consumer groups and the government over the last 5 years. I'll go through each of these in turn, starting with TEE. There's quite a lot of content to get through, so this will be a bit of a whistle-stop tour, but happy to go back to any areas at the end that people would like to discuss in more detail and answer any questions. And we should have time also at the very end, once Jackie's spoken as well, to take questions on this. So, there we go. So by TEE, I mean that income tax is fully applied to all contributions, but investment returns and income in retirement are exempt from tax. So as you can see, TEE fails against most of the principles. The slides have a short assessment against each of the principles, but I would like to draw your attention to a few in particular. So a move from EET to TEE would negatively impact adequacy, as it reduces the amount being saved and disincentivises saving into a pension, particularly compared to other tax incentivised savings like ISAs. Under TEE, a basic rate.
I'm going to interrupt you for a moment because we're getting a little bit of background noise from your dog.
Yeah.
And I wonder if we could give you a moment. We ask Jackie to give her presentation.
Oh, it's okay. I was going to suggest we could try and answer the question that someone
Oh, yeah, actually, just while
on our chat.
Just while Kate sorts out the domestic situation, I can see we've got a question that's just come in from Andrew Richardson, and maybe Nigel, you can give some perspective on that. He's saying, have there been any discussions about annual allowance, lifetime allowance, and the different applicability to DB and DC? Nigel, have there been discussions about that?
Well, so certainly our membership and our steering group have discussed these issues, and in particular about whether you have different limits. There are lots of different ways of looking at it. Obviously, we know the annual allowance is, a pain for people in DB final salary, in particular, because of get a promotion and you accidentally get tipped over. And then on the lifetime allowance, it creates lots of problems, of course, the way they measure it, which is on the size of the fund. It's not what you put in, but if you get good investment growth, you could potentially go over the limit. So there's lots of reasons to not like adjustments to these. And when, of course, they originally did the 2008 reforms, they had these very high, and that was right. But of course, the government's been squeezing down on those since then. So there have been discussions. We've also talked about whether to adopt different approaches. The government officials we've spoken to, they have also been thinking about these things. Politically, it's quite difficult for government because so many DB schemes are in the public sector. That if they reduced the annual allowance, well, either of them, but particularly the annual allowance, it could clobber DB more. That has lots of headaches for them. If they say it's not possible to adjust the lifetime allowance for DC because there isn't an overview of how much money has gone into pots from different employers. So it's being discussed. But I haven't picked up any kind of clear direction of travel. So I hope that gives Richard a little bit.
Yeah, that's great. So I'm sure that answers Andrew's question.
Sorry,
Kate, can we bring you back in now? Has calm been restored?
Yes, you can. I'm very sorry about that.
No problem. Let's pick up again with TEE.
Yes, thank you very much. So TEE, if we look at promoting adequacy, so we have done some modelling work on this. That Jackie will talk through later. But under TEE, a basic rate taxpayer would have a 20% reduction in their private pension income before tax. So would have quite a significant impact on individuals. TEE would also be a fiscally high-risk strategy for the government. So rather than as currently, where the government receives tax revenue from pensions at the point where people retire and are more likely to need health and welfare support, the government would receive it earlier. Also, few people would believe that a future government wouldn't be tempted to also tax pensions at the point of withdrawal, thereby making the system not TEE, but TET, which could also further undermine pension saving. We'll now look at a single rate. Sorry about this. A single rate at 20%. So this is one of the most talked about reform options. It's in the media quite a lot. But it is actually quite complicated and the implications aren't often discussed. So what we've tried to do in this report is draw out some more of those complications and what it would actually mean in practice for schemes and individuals. So a single rate of 20% is when the same rate of tax relief is applied to all pension contributions rather than at the saver's marginal rate of income tax. This meets more of the principles than TEE, but still fails on 3 of them. Jackie, in her presentation, will go through the impact on savers and draw out some of the modelling work that we did with the PPI. So what I would like to do is draw out the complexity for schemes and employers. So we believe a single rate would need to be applied to both the employer and employee contribution. Otherwise, it opens up a loophole for higher earners to still receive the full tax relief. And that wouldn't lead to the government saving money, which would probably be one of the main aims of doing this. And we believe this loophole would still be there, irrespective of removing salary sacrifice. So in order to pay the tax due on higher earners' contributions, we believe a new relief at source system would be needed for both the employer and employee contribution. This change would create complexity and significant additional cost for employers and schemes. There's more detail in the report about this, and we're also undertaking further work with administrators to understand this impact and cost in more detail. So now look at a single rate of 25 to 30%. So this is quite similar to the rate set at 20%, apart from basic rate taxpayers would be receiving a bonus and additional support, and the higher rate taxpayer would still see a reduction in their contribution, albeit less than at 20%. And this is why it receives a slightly more positive assessment, promotes adequacy and encourages the right behaviours. However, this would still involve complex and significant system changes to payroll to claim the additional bonus for basic rate taxpayers, and also for higher rate taxpayers to pay tax on their contribution. So reduction in annual allowance and lifetime allowance. So under this reform option, we've assumed that the annual allowance would be reduced from £40,000 to £30,000, and that the lifetime allowance would go from just over £1 million to £750,000. This doesn't achieve a positive assessment, again, simple to adopt. This does achieve a positive assessment, again, simple to adopt and administer and enduring and sustainable. This reform, and this is because it would be simple to adopt compared to something like the single rate. However, there is obviously still a large administrative burden for schemes and individuals. Lowering the allowances would also lead to a very substantial increase in the number of DB calculations which schemes need to undertake, and increase the number of savers affected. The impact would also differ between DB and DC, as kind of Nigel touched on, with DB savers more likely to be impacted, and particularly senior public sector workers, and we've seen that with doctors and the AA taper. So we'll look at capping the tax-free lump sum at 75,000. So this fails on most of the principles. Set at this level of 75,000, around 75% of savers would be unaffected. This estimate is based on the Wealth and Assets Survey data, and that's kind of current data looking at 55 to 65-year-olds. So if the level of 75,000 didn't increase over time, a greater proportion of savers would be affected. Capping the lump sum may also impact on savers' behaviour by disincentivising contributing beyond the point where an individual can no longer get additional tax-free cash. So for DC, this would equate to a pot size of 300,000. Also, if one of the aims of the government in reforming tax relief, as Nigel touched on, is to raise revenue, this change would have to be retrospective and not only on future accrual in order for the government to raise any revenue in the short and medium term. So now look at removing national insurance relief on the employer contribution. So this reform achieves two of the principles of simple to adopt and administer and enduring and sustainable. However, it does have implications for adequacy and promote and encouraging the right behaviour. So it would likely disincentivise employers from contributing beyond the minimum. For the employer, removing national insurance relief would increase payroll costs, and for the employee, lead to a reduction in contributions or take-home pay. Again, it would be simpler to adopt in comparison with some of the other reforms, particularly for DC. But for DB schemes, it would require changes to calculate the value of national insurance due on the employer contribution. So lastly, look at splitting. Lastly, I'll look at splitting DB and DC regime. So under this scenario, we have assumed that DB would remain unchanged and DC would move to a single rate of 25%. The benefits of splitting the regimes is that it would give more flexibility to make changes to DC and help provide more support to basic rate taxpayers in the form of the single rate. However, it would add complexities for converting from DB to DC and vice versa, and create arbitrage. It would also cause confusion for savers who have both DB and DC saving, and create issues for hybrid schemes and those with characteristics of both, such as CDC schemes. So we also considered the current system in our analysis. As you can see, it does achieve positive assessments on 3 of the principles. I won't spend too long talking about this though. As you can see, we believe it does promote adequacy. However, there are some areas of complexity which could benefit from reform. The main ones that we highlight in the report are the net pay RAS issue and the many purchase annual allowance. So on this slide, we have all of the different options together, and you can see our assessment. So our assessment suggests that neither the current system nor any of the options for reform meet all 5 principles. However, the current system satisfies more than any other option, and the lowest scoring option is TEE, which only meets one of the principles, and we believe would be kind of the worst reform that the government could go to. So finally, in conclusion, we believe that the current approach to pensions tax relief, in particular the EET system, should be maintained. However, we appreciate that it is a challenging fiscal climate with a lot of pressures on public finances. Therefore, if reform does happen, we believe it should be in line with the principles set out in this presentation and in the report. The implications of reform and how it can be implemented should be fully considered to ensure there are no unintended consequences. So it's essential that the impacts of changes be assessed, especially with regard to savers, schemes and employers. Also, if changes are to happen, the timescales should be realistic and practical. So as you've seen, depending on the type of reform, it may take significant amounts of time and investment to implement. So with a lot of these, they're not kind of a quick win for government. So that was a very quick run through there. The full report is on the website. As James said, we'll be sharing links. There's all the information in there and more, but happy to take any questions now.
Kate, thanks very much. It was really good stuff. And I think this way of assessing the different options against these 5 principles is a great way of looking at it and presenting our analysis to government. I mean, as you know, I try and get out and about, or at least out and about on Zoom nowadays, talking to a lot of our members. And I'm sure that the principle you've got there about ensuring any reform is relatively simple to administer is one that will really strike a chord with a lot of people on this call. We've got a lot of scheme managers on the call, a lot of admin professionals. So I'm sure that is all the others are key. I'm sure that is a key consideration. I don't know if you have any feel for whether that point has really sort of landed with the officials that you and Nigel and other colleagues talk to.
Yeah, it's definitely something we raise a lot, because it's not just this change by itself of tax relief that might be complicated. I think it's important for the government to consider it with all the other changes they're asking of schemes at the same time. So there is a lot of pressure on administrators at the moment. You know, there's pensions dashboard coming up, TCFD, there's lots of regulations of things that schemes need to do. And I think it's important for government, and it's a point that we try and put across. You know, there's only so many people, there are resource constraints. So you kind of have to decide what's your priority as government for schemes to be doing. Yeah.
Now, just to our audience, and I'm going to bring Nigel in a moment, but do type your questions in the Q&A box. People are being a little bit shy this morning, so do type them into the Q&A box. We did have one in the chat box earlier, which is absolutely fine, but the Q&A box really is the place for questions. Nigel, it looked like you might just have a comment on the perhaps on the admin issue.
Yes, and indeed, I think it relates to the new question in from Marlene. She said, do you have confidence government will consider all the implications before action is taken? So I was going to say, I mean, I don't find this government has a lot of concern for the implementation aspects of reforms and changes. And, you know, it's to be understood, I guess, but it is a bit disappointing. I've been kicking around this area for several decades now. And, you know, I can definitely think of times when government was much more interested in having a low cost impact on industry, trying to facilitate growth. Whereas this government doesn't seem very interested in impacts on business. I know they are keen to have growth, but they don't seem very interested in impacts on business. So they haven't focused a lot on the admin costs. We've drawn out the issue, and I'm glad that we've done so. I mean, what's quite interesting is that when I was, you know, we did our first report assessing from all angles the impact on the saver, on government money, on pension schemes, on adequacy, fairness. You know, we looked at it all in the round. But when I went back and was talking to some of the politicians on this, in the spring, I was finding they hadn't really heard a lot of that. They hadn't heard a lot. What they'd heard was, oh, you guys think this is going to be really hard and expensive to implement. And that was about it. And that was partly why, as we'll go on to, we did the second report focusing just on savers, people who vote for MPs, and to help try and get the politicians' attention focused on this issue. So that also, we'll come on to that. But I'm not confident government will consider. The civil servants will. The civil servants, try and do a good job of weighing up the pros and cons. Then politicians are very focused on popularity, the media, and the next election.
Of course. And Martin says, thank you for being so open, Nigel. So
I must have said too much.
Probably have. I mean, on that issue of adequacy, I don't know, Kate or Nigel, I don't know which of you might want to answer this. We've done our retirement living standards that a lot of our member pension schemes are using, which provide people with a way of understanding what kind of income they need in retirement in order to fund the kind of lifestyle they want. And it's been good to see so many of our member schemes making use of those, put them on their websites and in their newsletters. To what extent do you think government is aware of those and using them as a tool for analysing any potential pension tax changes? I don't know if Kate or Nigel, which of you wishes to pick that up?
Right, well, I might just say a few things. So I know that officials are aware of them, both in the Department for Work and Pension and in the Treasury. In our retread of the 5 Principles report that Kate talks us through, the initial section focuses on adequacy, and it actually includes comparisons of current pensioner incomes by quintile and how they relate to the retirement living standards. And the slightly shocking thing is the sort of 20 to 40% of people who are sort of actually down below the minimum level. On the other hand, I have to say that doing that analysis does make the retirement living standards look like they're at about the right levels, because they well reflect the spread of incomes in society. I'll just say briefly, the Plsa doesn't make up those levels of 10, 20, 30 for singles, 15, 30, 45 for couples. That comes from extensive research from across the UK carried out for us by Loughborough University, who do the Joseph Rowntree Foundation minimum income standard. So in brief, the officials are aware of it. We've referred to it in our material with ministers. I just don't, because it's a long-term issue, I just don't think government is very focused on that at the moment.
Okay, and let's pick up a question that's come in from Timothy Wood, who says, would TEE appear more desirable as a reform if work or modelling were done on a potential government contribution in addition to member contributions to a new pensions ISA? Kate, did you have a comment on that?
Yeah, so that would be more favourable. The impact on private pension income would be less. I mean, you can kind of consider a single rate as sort of TET in a way, because you're not getting your full tax relief on your contribution. So for higher earners, it would definitely be TET with a government bonus of 20%. So some of that modelling you can kind of see there that Jackie will go through has a bit more of that impact.
Yeah. Okay, thanks.
Jackie, did Jackie want to add a big picture point on TEE, Jackie?
I think, yes, I mean, it is a very fundamental reform, even if you add a government contribution back in. And I think the underlying concerns that we in the stakeholder group, the steering group had on this reform was the lack of confidence that individuals might have in future government policy. Having made the final T into an E, it's then very easy to start reintroducing tax on pensioners by future governments. And I think the other big issue with TEE is that unless legacy pensions are dragged into the new regime, then you end up with systems having to run two pots for people and having to identify them separately for tax purposes. It becomes very difficult to explain to individuals, and essentially pensions become ISAs. So pensions, in a sense, have no longer have a distinct place in saving for later life.
Okay. Well, Jackie, I think you've given us your own cue for us to move on to you and ask you. I know you've got some slides to present on the modelling work we've done. So over to you, Jackie.
Thank you. So I'm going to share some of the analysis that that PLSA has done on the numbers that were generated by PPI for us on the impact on savers of some of the potential tax reforms that Kate's talked about and Nigel's talked about. So a little bit about the modelling work that we've done with PPI. The modelling was designed to reveal the impact of different tax regimes. So we actually modelled several different reforms, including TEE, and a range of flat or single rates of tax relief, income tax relief, important to say. And we did that for a range of different individuals, essentially defined by their incomes and their tax rates. So we modelled for 7 individuals, and I'm going to talk about 4 of those in today's presentation, but the full report has a wider analysis. And for each of those individuals, we put them into 3 different schemes to see what the impact of the scheme might be on the tax reforms. So we put them into a minimum auto-enrollment scheme with applied to banded earnings. We put them into a 12% contribution on total salary in a DC scheme, and we put them into a DB scheme, which PPI based upon the NHS scheme. So important to just talk through a little bit about the assumptions that we make with these numbers. So we assume that individuals stay in the same pension scheme, albeit one of 3, throughout their careers. So they don't stop and start, they don't switch scheme, they're not switching employer. We also importantly assume that they don't take their tax-free cash. So when you see the figures on private pension income, we've assumed that they use their tax-free cash to boost their income tax-free. So that's added back in. We assume for DC that they draw down 3.5% of fund, which is a standard PPI assumption. And we assume that we also present to you total retirement incomes, which include the state pension, which has been inflated by the triple lock, with private pensions inflated by CPI. So some important things to talk about with the flat rate. In DC, it's important to understand that what we've done is to tax both employer and member contributions at the individual's marginal rate and have the flat rate rebated to the pension. So this is what Kate talked about as the new relief at source scheme that we've assumed would be applied. And we've assumed that after quite detailed discussions with tax groups, with payroll professionals, and importantly, with the Treasury. In order for the revenue to be generated under a flat rate, it does need to apply to the member, the employer contributions as well as the member. And we believe that that would be achieved by taxing all contributions and then rebating the flat rate. Importantly, those who are on the cusp of a tax rate band therefore get bumped up potentially by their pension contributions. And if they are a higher rate taxpayer or on the cusp of a tax band, then in DC, they pay less into their pensions and they pay more tax. So we've assumed that their take-home pay is left unchanged, but they pay less into their pension. For members of DB schemes, We've assumed that contributions stay the same because those are set by the scheme actuary in conjunction with the employer. But the benefits are either reduced for higher earners each year or boosted for lower earners if the rate of tax relief is higher than basic rate. So in effect, what we're saying schemes will have to introduced is an operationalized scheme pays mechanism for higher earners and a new scheme boosts system for lower earners. The alternative to this is that higher earners simply pay more tax each year and lower earners are rebated money into their payroll rather than into the scheme. But for comparison purposes, we've assumed that those mechanisms apply. Everything you see in here is expressed in 2021 values. We're using the discount rate that PPI normally apply to their modelling. And we haven't allowed in salaries. When we talk about salaries, we haven't taken off NI payments. So pre-retirement incomes would be a little bit different if we took those into account. So I'm going to talk through 4 of the individuals that we modelled, and they're all presented in much the same way. So I'll describe Alex's numbers in a bit more detail, and then be a bit more superficial about the others. So for each individual, we've defined the starting point for their pension contributions. And for Alex, she's aged 22 in 2021, and she starts contributing to a pension. She contributes for 46 years. And then we assume for all of our individuals that they're retired for 32 years. So we stop paying their pension at age 100. Alex is a median earner throughout her career. So at every age, she is a median earner for that age. And she stays a basic rate taxpayer throughout her career. She has a gross income in 2021 of £19,000 and a gross income just before she retires of 29,000 in 2021 values. So her income does go up, but she stays a basic rate taxpayer. And the type of job that Alex might be doing is perhaps a retail store manager throughout most of her career, or perhaps a mid-ranking nurse. So a number of figures here. If we start on the top right with the chart there, that shows you the private pension income at state pension age that Alex would receive in various scenarios before tax is taken off. And then we have the 3 different schemes that we've put Alex in. So we've put her into a DC auto-enrollment minimum scheme, a 12%, and a DB career average scheme. And you can see immediately that the scheme that she's in, perhaps inevitably, generates a very different pattern of private pension income before tax. And you can see immediately the DB figures are, as you might expect, much, much higher. And then we have 3 tax scenarios. So in each scheme, we have the current system of EET, and we show you the pension that would generate. We then set the single rate of tax at basic rate relief only. And then we set the single rate of tax at 25%. So you can see that in a DC auto-enrollment scheme, Alex achieves a very slightly higher, by £300, private pension income at retirement before tax. And a similar pattern in a 12% scheme and a similar pattern in the career average DB. So very slight increases if the single rate is set at 25%, but no effect at all if the single rate is basic rate relief only. So that's the top right chart. The bottom right hand figures show you the average total take-home retirement income, assuming no lump sum is taken, again for the 3 schemes and for the 3 different types of tax relief. And the colour coding in this is designed to illustrate how well Alex does in terms of the PLSA retirement living standards. So you can see that Alex achieves a take-home retirement income on average across her retirement in a DC auto-enrollment scheme under today's system of 14,100, and that goes up very slightly under a 25% single rate. But Alex is still only achieving a minimum retirement living standard for a single person. If she's in a couple, then that changes. But as a single, she only achieves minimum. And the same is broadly true in a 12% DC scheme. It's only when if Alex is in a DB scheme that she achieves a moderate retirement living standard, so the yellow. And in fact, a single rate of 25% boosts her up to a comfortable retirement living standard if she has a whole career in a career average DB scheme. So those are those numbers. What we also have is we've calculated the Pensions Commission replacement rates for all of these individuals. And you can see on the left-hand side that Alex achieves in an auto-enrollment scheme, she achieves 52% under current tax arrangements as a replacement rate. And that goes up very, very slightly to 53% under the 25% tax single rate. She achieves a higher replacement rate, 62%, 63% in the DC scheme, and a very comfortable retirement rate of in excess of 100% in a DB scheme. So that's Alex, a basic rate taxpayer. If we now look at Chris is a basic rate taxpayer for much of her career, but we artificially boosted her income and made her a higher rate taxpayer for 10 years in the middle of her career. So Chris might be perhaps a local solicitor, working part-time some of the time, full-time some of the time, or even a GP working part-time some of the time, full-time some of the time. Again, she's age 22 at the start. She works for 46 years. She's retired for 32. And she starts on an income of 24,500 roughly, and then ends at retirement on an income of just under 42,000. So she's back to being a basic rate taxpayer at the point that she retires. So you see the same charts again. So the top right is her private pension income before tax, not taking a lump sum. And she in an auto-enrollment scheme, that generates a private pension of 6,000, slightly more than that under a flat rate of 25%, and the same sort of pattern in 12%. So she loses out slightly if it's basic rate relief only, but gains a tiny bit if it's a 25% flat rate. The position in DB is a little different because the contributions are so much higher, or the deemed contribution is so much higher, then she loses out under both of the tax scenarios. So her income in retirement will drop. And you see the effect of that in the table below that, the chart. So in DB, Chris currently achieves a comfortable retirement living standard, but that drops down to a moderate retirement living standard under a basic rate relief only. And her, in DC, she fails to achieve more than a minimum retirement living standard, even in 12%. So, and if you look at the replacement rates, you see a similar pattern to the basic rate taxpayer, not achieving the targets in DC, but exceeding the targets in DB. Ronnie is our higher rate taxpayer, and we've given her a couple of possible jobs in the private sector, maybe an optometrist, and in the public sector or quasi-public sector, an associate professor. So she might be in the USS scheme. She's age 22 again. She works 46 years, and throughout her career, at every age, she is a 90th percentile earner for her age. And so she becomes a higher rate taxpayer from the age of 29 and stays a higher rate taxpayer throughout her career. By the time she retires, her gross income is 64,000. So she's only just a higher rate taxpayer. You wouldn't perhaps say she's a very, very high earner. And this is where we see the real impact of the potential tax reforms. Ronnie loses out in both of the scenarios that we've painted here. She loses out by nearly £1,000 in a DC auto enrolment scheme, and by well over £1,000 in a 12%. In DB, she loses very, very significantly because she is paying tax on her contributions, or her deemed contributions in DB. And that has an impact on her retirement living standards. So she has a minimum retirement living standard in most DC scenarios, but she drops down from moderate to minimum in a 12% DC scheme. In DB, although her income drops very significantly, she still maintains a comfortable retirement living standard and a replacement rate well over 100% of her pre-retirement income. And then finally, Sam. So Sam is at the other extreme of the income spectrum. Sam is a non-taxpayer throughout his working life, perhaps working in a part-time in a call center, or in the public sector, perhaps administration in a local authority, part-time perhaps again. His income is set at £12,000 in 2021 at age 22, and he never achieves in real terms an increase on that. So he stays a basic non-taxpayer. And Sam is the real winner in these tax scenarios. Sam gains in every single tax scenario, and the gain in nominal terms is greatest in a DB career average scheme. However, as you see from the bottom of the chart, or the table at the bottom, he still only achieves a minimum retirement living standard in these scenarios, and it's only in a DB career average scheme that he's boosted up to a moderate retirement living standard. Moving, so just to summarize those things, moving to basic rate tax relief, the chart on the top right, as you can see, creates some winners and losers. Sam is the big winner, whereas Ronnie is the big loser. And the individual that I didn't present in detail is Jamie, who is an individual whose earnings are always, salary is just below the higher rate. He loses out because his employer contribution gets added to his income for tax assessment, and so he starts to pay higher rate tax relief, tax on his employer contribution with a rebate of the flat rate. So he loses out, and Chris, as we saw, loses out a little. If we look at it for a 25% flat rate, then you have broadly the same winners and losers. The big difference is that Alex, who is our basic rate taxpayer, does start to have a slightly higher private pension income. So I won't go into these charts in detail, but suffice to say that most of the individuals that we modelled failed to reach their pension commission target replacement rates in DC schemes. Non-taxpayers like Sam achieve more than 80% in all schemes and all scenarios, but all of the other individuals that we modelled only achieve the target in DB schemes. And it's also clear that achieving a comfortable retirement living standard from pensions is difficult for most individuals, regardless of the scheme or the tax relief. In spite of their target replacement rate, non-taxpayers still only achieve a minimum retirement living standard in all but DB. Median earners only achieve a moderate or comfortable outcome in a DB scheme, but minimum in all DC. And higher rate taxpayers also, perhaps surprisingly, only achieve a minimum outcome in DC. And so what we feel that the modelling does highlight really strongly, and it's a point PPI have made in many of their reports, is the importance of contributions and scheme type over and above any tax scenario in generating different retirement outcomes for individuals. And that we feel is an important take home from this modelling. So that is it from me.
Thanks,
happy to take questions.
Yeah, and we've just got a few minutes left, so quick answers, please. Jackie, one question for clarification for you from Kate Barker. Dame Kate asks, in the Alex slide, your first scenario, what are the assumptions for contributions and returns that are driving the big difference in DB? Don't know if you can answer that.
So with DB, what we've done, and this is probably needs a much longer conversation than we have time for, but we have made an assumption that the deemed contribution into DB would be calculated in the same way that the pension input allowance is currently calculated for the annual allowance, rather than the actual contributions themselves. So we've used the PIA calculation, or rather PPI have, to drive the amount of tax that would be payable by higher rate taxpayers and basic rate taxpayers. For Alex in particular, sorry, I've lost the slide. For Alex in particular, she's boosted under a 25% tax rate, but for those you saw for the higher rate taxpayer, there's a significant loss of private pension income on the basis that scheme pays the tax that's due, and so you reduce the benefits in an equivalent way. I hope that's answered it, but the full report might give you a better answer.
Absolutely. Thanks, Jackie. And Nigel, a quick one to you from John Wiggins, who says, given most of the barriers to pensions tax reform centre around DB schemes, and that most of remaining DB are in the public sector, could the government use tax reform as a reason to move public sector schemes to a less expensive DC structure? Controversial.
So I'm sure some politicians would like to do that. I'm mindful of the Hutton reforms from 10 years ago saying, we've gone where we've gone to care for a generation. Generations probably more than 10 years. It feels like in maybe another 10 years' time, they could make a case about moving either to DC or CDC. James, I see Jerry Gandy. Hi, Jerry. I see Jerry's asked a tricky question. Why don't we just kind of treat it?
I was going to pick that up. Go ahead.
I thought you might. Yes, I mean, Jerry said pensions tax relief is far too complex. Why don't we just have a tax credit? I know it's tough on DB. I think for me the issue is that DB exists in the public sector and the private sector, and so what you're effectively saying is let's treat DB and DC differently, and we've got that analysis. Lots of arbitrage issues, lots of unfairness issues. Somebody, perhaps a very brave politician, might like to try and engage with that. On your other point about the sort of, I think you've got two other points there really. You're suggesting a tax credit would deal with the problems around low earners. I think there are other solutions to the net pay RAS issue for low earners. There's that P800 solution, which if only HMRC would adopt would solve it. And then just finally, on your point about, wouldn't it make it much simpler just to have a tax credit? Well, the reality is, I don't disagree, Jerry. That is very appealing. But as we know, people don't have much understanding of pension saving. The main thing they seem to grasp is that the 25% tax-free lump sum. But I can promise you, we did agonise over this one very carefully with the steering group.
Okay, thank you. Well, we are going to have to draw this towards a conclusion now. We will circulate, as I said, the slides, the links to our 2 PLSA reports to you all, and also the recording, so that will come round. I want to just give a brief mention for events that we've got coming up, notably our annual conference, just a month away, less than that, 12th to the 14th of October online, and it's all open for registration. We've got a tremendous lineup of speakers, including Sarah Smart, the new chair of TPR in her first major public outing, Guy Opperman, the Pensions Minister, Stephen Timms MP, who chairs the Work and Pensions Committee, a key contact, Beth Rigby from Sky News, Andrew Dilnott, Sir Andrew Dilnott, who's an expert, of course, on social care reform, and the list goes on. So do register for that. It's open to everyone at your schemes, your colleagues and your trustees, all free to attend. We also have a couple of webinars coming up shortly, one on cost transparency initiative and just on the 23rd this week, and one on liability driven portfolios on the 30th of September. And don't forget, our trustee training courses are always there, and we've got our part 2 course coming up on 19th and 20th of October. So other than that, thank you very much indeed to our speakers, to Jackie, to Kate, to Nigel for excellent contributions. Particular thanks from me to my colleagues who make it all happen behind the scenes. That's Cheryl Wilkinson and Rebecca Motel, and Nicolina Hoody and Molly Mayo. They've done a great job this morning. And thank you to everyone who's dialed in for what I think has been a great session. Thanks, and enjoy the rest of your day. Bye now.